My name is Pat O'Connor, and this is video number 12 in my mortgage exam tutorial series. Today we'll be talking about FHA loans, but first I just want to let you know that this material is taken from the study guide that I wrote and published on Amazon. The link is up here. It's available in both Kindle and paperback format. But I personally think that the paperback format is easier to use for the questions and answers. Also, there are vendors that sell the used books. I update my book every year, so if you get a used one, it may or may not be updated. I have the copyright in the front of the book, the year, so you can kind of tell if it's up to date or not. Okay, the second thing is that I make quizzes available to subscribers. If you surf incognito and you have subscribed incognito, I can't see your name. Somehow you need to fix that if you're going to request a quiz, because a name on the request has to match one of my subscribers. So the full instructions on how to get the download link are at the end of the video. I do follow the NMLS content outline for the exam. There is a link to that in the description of the video. I also suggest, even if you don't want the quiz, that you subscribe either here on the red link, or there is, again, a link to the channel where you can subscribe. That way you're not going to miss anything. I know a lot of you may be in a hurry. You may be taking the exam next week. So if you pass, you don't care. But, you know, it's important information, and I think I do a decent job. Okay, let's get started. FHA. FHA stands for Federal Housing Administration, FHA. It is an agency within the U.S. Department of Housing and Urban Development, called HUD. These loans have high fees that we'll talk about in a minute. So they're really geared towards people that cannot obtain a different type of loan. They are for individuals with low credit scores or high debt-to-income ratios are the ones who are going to most benefit from this type of loan. The FHA itself doesn't lend the money. What it does, it 100% insures the loan for the lenders. So if the lenders end up losing money on a deal, maybe through a foreclosure or through a short sale where it may sell for less than the balance of the loan, the FHA will reimburse the lender for their losses. Okay, sounds good. Where does the FHA get their money from? This is where the high fees come in. To begin with, you have a fee at closing called the Upfront Mortgage Insurance Premium, or UMIP, all in caps. If you see that, it is associated with an FHA loan. That particular fee can be added to the loan balance, so it can be financed. It is 1.75% of the total loan amount. Then monthly, you have a mortgage insurance premium, MIP, if you see it on a quiz. And it is if you have a loan that's greater than 15-year term, regardless of the down payment, you will pay this mortgage insurance premium. Remember, this is going into a pool of money that reimburses the lenders. That's why they have these high fees. The MIP cannot be canceled if the down payment is less than 10%. They require 3.5% minimum. But if you put down less than 10%, you are going to be paying this mortgage insurance premium for the life of the loan. You cannot cancel it. You can refinance out of it into a conventional loan that doesn't have this. But otherwise, you're paying this mortgage insurance premium for however long you have the loan if you put down less than 10%. If you put down more than 10%, it will cancel after 11 years. So in the United States, most people in the U.S. tend to move every 5 to 8 years. So chances are you would have already moved and paid off the loan before you had the opportunity to cancel it. Okay, so remember, UMIP, upfront mortgage insurance premium, is a closing cost, 1.75% of the loan amount, and MIP, mortgage insurance premium, that you will pay monthly. All right, qualifying properties. These are for residential loans, 1 to 4 units. Owner occupied. Now, if it is a duplex, triplex, or fourplex, the buyer can buy it with an FHA loan if they live as their permanent residence in one of the units. FHA does not lend for vacation homes. None of these government non-conventional loans will cover vacation homes. All right. Borrower qualifications. I am filming this in 2022. The qualifications may vary, sometimes between year to year. Not usually, they're pretty stable, but one thing or another, like minimum credit score may change sometimes. But right now, the FHA establishes the minimum guidelines. But just because what I tell you now is what the FHA allows, it doesn't mean individual lenders will allow that. They may want to be stricter. For example, the minimum credit score is 500 with the FHA guidelines. But you will see on some mortgage websites, they're going to require 580. And so even though they're getting reimbursed by the FHA, if they have losses, they don't want the extra risk of doing a loan to someone who does not have a history of good credit. Okay? So FHA allows 500, but lenders could say 580. The maximum debt to income ratio is 43% for a standard FHA. But again, because these loans are available to people who can't otherwise get loans, that debt to income ratio may be increased up to 50% if they have other compensating factors. Maybe they have a lot of money in the bank. Maybe they have a really high credit score, but they just also have a lot of debt. So your debt to income is your monthly debt, including the projected mortgage cost, plus other regularly scheduled monthly payments, like car payments, car lease, alimony payments, divided by your monthly income. So if that's 43% or less, you're good to go. And if it's 50% or less, half, then you may be good to go. If it's over 50%, you may end up having to pay something called hard money, where the lender will loan you the money, but they're going to charge you very high interest. But keep that in mind. If you're a mortgage broker, maybe you have some kind of a connection with a hard money lender. I don't know. But that is another option for individuals. 2022 down payment requirements. 3.5% minimum down payment if the credit score is 580 or higher. 10% minimum down payment if the credit score is 500 to 579. Again, these are FHA guidelines, not necessarily lenders. The entire down payment can be a gift, as long as there is a donor letter that accompanies the loan application that says this was a gift and it does not have to be repaid. And I'm not sure if that letter needs to be notarized or not, but for the exam, you don't care. Okay? So the entire down payment, the entire down payment can be a gift. Maximum loan amounts, again, 2022 standards, depends on the number of units, 1 to 4 units, and the county where the property is located. Right now in 2022, it's about $420,000 is the floor, and about $980,000 is about the top. And right here, I'm in Florida. In Florida, Key West, Monroe County, it has our highest FHA limits for 2022, and they're like about $750,000. Seller concessions. This is where the seller agrees to pay all or some of the borrower's closing costs. In the market that we are in now, it is a seller's market. There's not much inventory, and buyers are begging for homes. So the seller is not going to agree to pay any of the buyer's closing costs because they don't have to. They may have 10 offers right behind the one who's asking for seller concessions. But if the market flips and it becomes a buyer's market, or even a normal market, but a buyer's market is when there are lots of homes for sale. And not necessarily a lot of buyers, but the buyers have a big choice. If one seller doesn't want to give concessions, then the next one may, and sellers know this. So seller concessions for an FHA loan, they can contribute 6% of the list price. Not the loan amount. They can contribute 6% of the sale price, but it cannot include the down payment. Down payment can be a gift from, not the seller. It can be a gift outside of that. A friend, a relative, coworker. Okay. Appraisals. FHA have their own FHA appraisers. And an FHA appraiser is going to have a checklist, and they have to go through the property, and it's a stricter inspection, a more thorough inspection than your normal home inspector will do. So if it comes up with minor repairs, you know, those can be fixed. If it comes up with major repairs, they may have to flip into what's called an FHA 203K rehabilitation loan. And, you know, if you're a loan originator, your company may not have signed up with a lender who does these loans. So you might lose the deal. There's not a lot of lenders out there that will do these rehabilitation loans because sometimes it requires oversight on the part of the lender. Come out and inspect and that kind of stuff, and they don't want the hassle. So if there's major repairs to be done, either the deal is lost or they have their 203K rehabilitation loan where they can buy the property with damage, and then they have like 6 months to have it corrected. I think it's 6 months. Could be 3 months, but I think it's 6 months. Okay, income requirements, there are none. There's no minimum income that you need. Again, it tends to be for people with lower income because of these debt to income ratios can go all the way up to 50% if they have other good things in their history. The loan feature a minimum loan term of 30 years, fixed interest rate as well as adjustable interest rates. These loans, all government loans, are assumable by qualified buyers. It means they can take over the terms. So if you had an interest rate, say you bought a home in 2021, you could have an interest rate of 2.5%. Right now, they're 5.3%. And they may very well be, you know, 6% or 6.5% or 7% by the end of the year, according to the latest announcements that the government has made. So all the FHA loans are assumable, and it makes sense if, you know, the seller has a low, is currently paying a low interest rate. There is a 4% late fee that is also standard on all the conventional loans, on all the government loans. All right, so that's it for FHA. Next week, we'll talk about the VA loans. These videos are available every Wednesday. There's a new one until I run out of material. Okay, if you liked the video, think you learned anything, you could please like it. And I also encourage you to subscribe. Okay, buy the book. Okay, goodbye. See you next week.